Okay, everyone, welcome to this webinar. Happy that you guys could join us. We're gonna take the hour today, and we're gonna go over some of the tax provisions in the recent legislation that was passed at the end of 2020. There's a lot to digest, and so we want to get right in. This is me. My name is Craig Swindlehurst. I'm a senior tax manager at Larson. I'll be presenting. So there's over 100 participants today, and throughout the broadcast, if you have any questions, we've enabled the Q&A feature, and we have Greg Denning and Rick Van Valkenburg, both tax partners here at Larson, and they will be responding to questions as you ask them in the Q&A. So please use the Q&A, not the chat box, to get questions answered, and we'll try to get through as many as possible during the broadcast, and then at the end we'll try to wrap up any questions that haven't been responded to. So with that, here's the agenda for today. We're going to go over, I think, two of the bigger ticket items in the legislation were the updates to the PPP loans and the employee retention tax credit. And those will be the first two items we'll cover. And then we'll briefly touch on some other tax provisions that were in the law, and also talk about some things that President Biden might have in the pipeline for us from a tax perspective on a go-forward basis. So without further ado, let's jump into the PPP loan updates. So the new legislation, it made changes to the PPP loan program, both for PPP loans that businesses have already received, and also for a potential second PPP loan that will be available to certain borrowers. So first, I'm just going to cover some of the changes to the first round of PPP loans. And the biggest change that many of you may already be aware of is that Congress overruled the IRS and has made the expenses paid for with PPP loan proceeds deductible. So that's a huge benefit to taxpayers. The other big change, and we'll talk a lot about this, is there's this employee retention tax credit that we're going to go over later. And originally in 2020, if you had received a PPP loan, you weren't able to take advantage of that credit as well. But they've changed that, and they've said, okay, retroactively, if you want to go back to 2020 and you have a PPP loan, you can retroactively pick up this credit. And so we're going to talk about how that works. And the one thing to be aware of as we talk about it is you can't double dip. So if you've got a PPP loan and you've paid wages with that PPP loan and received forgiveness, you're not able to take this employee retention tax credit on those same wages. They've got to be different wages. So again, more to come on that in a second. Another big change is if any business received an EIDL advance, originally that was required. You had to decrease your loan forgiveness by the amount of the advance you received, but that's no longer applicable. And there may be borrowers that already applied for loan forgiveness and decreased their loan forgiveness by any EIDL advance they received. The new law says that those borrowers will be made whole. So somehow they'll get repaid for that, although we're not sure how yet. And then another big change is the new laws allowed for some more flexibility when it comes to covered period. So if you received a first PPP loan and you're looking to apply for forgiveness, your choice is to choose either an 8-week period, covered period, or a 24-week covered period. But now you can elect any period between 8 and 24 weeks. You can choose the most advantageous covered period for you. And The reason this is important is really has to do with, your full-time equivalents. And if during your covered period, you had a decrease in full-time equivalent employees, then you could have your loan forgiveness decreased. And now that you're able to choose your own covered period, you could select the covered period where you don't have any full-time equivalent decreases. And thus your loan forgiveness will be 100% in theory. So that flexibility is really beneficial, just to kind of figure out how to maximize your loan forgiveness. And another important update that they made is that they've expanded the amount of expenses for which you can use your PPP loan proceeds. Now, you have payroll, you still need to use 60% of your PPP loan proceeds on payroll to get full forgiveness. But that other 40%, originally it was rent, utilities, certain interest, but they've opened that up to a few other expenses. Operating expenses, what that relates to is if you pay for business software or, cloud computing services that facilitate business operations, payroll, inventory management, HR, those type of expenses are eligible now. So if you're paying for QuickBooks, or if you're paying for, a payroll company to process your payroll, those kind of expenses, most businesses will have those and can now include them. Supplier costs, if you pay a supplier for essential supplies for your company, those can be included. Property damage, worker protection costs, things like if you bought masks for the office or plexiglass, you see plexiglass when you go to the store now, those kind of costs can be qualified expenses for PPP loans. And the reason this is important, and again, we'll get into this, is you've now in 2020, you can go back and try to claim this employee retention tax credit. And again, we'll get into this more later, but to claim it, I said earlier, you have to use different wages than the wages you put on your PPP loan. And so to the extent, when you're doing your loan forgiveness, to the extent that you're able to include as much other expenses as possible, that will free up more of your wages on which you can take the employee retention tax credit. So before, kind of the idea was, well, it's easiest, let's just use payroll on our PPP loan forgiveness application. It's the easiest thing. We have plenty of payroll. But now I think the shift should be, okay, well, let's try to get as much other costs in there so that we can still maximize our loan forgiveness, but then also maximize our ability to take this credit. So again, we'll get more into that. So the other change they made was, if for whatever reason you applied for a loan, but you didn't get the full amount that you could have, perhaps you applied before, certain guidance was released, they're allowing first-time or businesses that had a first-time loan to go back and modify their loan in order to get the max amount. They're also introducing a simplified forgiveness application for loans under $150,000. It's going to be one page. And what I see, there are really two big benefits to this, besides being a simple form to fill out. One is that the documentation requirements are a lot less. So the SBA, for most loans, they have 6 years to audit them. But for loans under $150,000, they only require you to retain employment records for 4 years and other records for 3 years. So it would seem that the statute of limitations on these loans under $150,000 is 2 years shorter than loans over $150,000. That's a big deal. And the other benefit is the simplified forgiveness application process is a lot more simple. You don't need to provide all the detailed reports that originally we might have had to provide. The application asks for your total loan amount and then an estimated amount of payroll costs. And so our understanding is that whereas before the idea was, well, I got to get all these payroll reports, I got to send them all to the bank, they've got to come back and ask me questions, and a lot of back and forth between the bank to make sure they're okay with the documentation. It would appear that these loans under $150,000, it's going to be a lot more simple, and the upfront documentation won't be required. Although you're going to want to have it, obviously, just in case of an audit by the SBA. Okay, so now let's get into the second PPP loan that's available. So the government is introducing a new round of PPP loans. To qualify, you have to meet certain requirements. You have to have shown a 25% decline in gross revenue for any 2020 quarter compared to the same quarter of 2019. So you look at Q2 2020, you compare it to Q2 2019 and see if there's that 25% decline. If there's not, then you go to Q3, then you go to Q4 or Q1 even. You have to have 300 or fewer employees. You have to have used all of your first PPP loan and been in operation as of February 15, 2020. It's very similar to the first round, same terms, 1% rate, 5-year term. And the deadline to apply is March 31st. And applications they've opened them for some borrowers, although it's very limited scope right now. Chances are your bank has already reached out to you and said, hey, this is coming. We'll let you know when the application portal is open. I expect it'll be in the next week or so. So one important thing to note is if you didn't get a first PPP loan, you can apply for a first PPP loan. And the difference is if you apply for a first PPP loan now, you're going to be subject to the original PPP loan rules, which was 500 or fewer employees. You don't have to show a decline in gross revenue. Only those that are applying for a second loan have these new requirements. But just because you didn't apply for a first one doesn't mean you can't get a first one now. They're opening it back up not only for second-time borrowers, but also for first-time borrowers. The amount that you can receive is calculated the same way, taking your average monthly payroll, multiplying by 2.5. You have different periods that you can elect when determining average monthly payroll. The maximum loan available is $2 million compared to $10 million before. And they've also, in order to help kind of harder hit industries, they're allowing borrowers that file under the NAICS code starting with 72, which is kind of your food sector accommodation, so hotels, restaurants, they can use 3.5 multiplied by their average monthly payroll. So the loan that they'll be able to get on the second round should be larger than what they were able to get on the first round. Okay, so that's the PPP loan program. Again, not open yet for all borrowers, but gonna start soon. And so now what we're gonna get into, which I think is the most impactful aspect of this new legislation, is the employee retention tax credit. So it was introduced with the CARES Act. It's a refundable payroll tax credit that's calculated based on wages paid to employees. And when the CARES Act was released last year, we didn't pay as much attention to this credit because you weren't able to take it if you had a PPP loan. And most businesses, a lot of businesses had PPP loans. And so it just wasn't something that was on everyone's radar as much as it is now. So the major retroactive change they made is you can take it now in 2020. If you have a PPP loan, that's going to apply also to 2021, because what they did is they modified your ability to take the credit in 2020 by allowing you to take it even if you have a PPP loan. And they've extended your ability to take the credit into 2021 for the first 2 quarters. And we'll get into the rules that apply to 2021, because there's different rules for 2020 and different rules for 2021. But the first thing we're going to do is go over the rules for 2020. If you're a business that received a PPP loan, you obviously didn't take this credit in 2020, but now you have the chance to potentially go do it. And so we want to go over the 2020 rules to make sure that everyone understands how they might qualify. So first, just how the credit is calculated. It's a credit calculated on a per employee basis, and it's equal to 50% of wages you pay to employees up to $10,000 per employee on an annual basis. So the maximum credit you can get on a per employee basis is $5,000. And qualified wages has a different meaning based on your size. If you're a large employer, which is more than 100 full-time employees, the only wages on which you can take the credit are wages that you pay to employees who were not working at the time. So perhaps they were furloughed, perhaps you had to close your doors for a few weeks, but you still paid employees. Those are the wages that would qualify if you're a large employer. If you have 100 or less full-time employees, then all wages potentially qualify, meaning as long as they're wages that aren't included on a PPP loan forgiveness application, you could potentially get the credit on all your wages paid to employees, whether or not they were working. Couple things: if you're an owner employee and you own more than 50%, your wages, you can't get a credit on your wages or the wages of any family member. So in order to claim the credit, there's two requirements. You have to meet one of them. And the first requirement is that you have to show a decline in gross receipts of over 50% in a given quarter of 2020 when compared to the same quarter of 2019. So once you've done that comparison and you've compared 2020 to 2019, and there's a quarter has the decline of over 50%, that becomes an eligible quarter. And then all wages in that quarter can now qualify for the credit. And the large employer rules still apply, meaning that if you find out, if you have an eligible quarter and you're a large employer, it's only going to be the wages you paid to employees who were not working. But if you're 100 employees or less, then it's all wages. So once you've got an eligible quarter, let's say in Q2 you had the 50% decline, you're gonna be able to keep taking the credit in future quarters until the end of the quarter for which your gross receipts in 2020 are restored to 80% of 2019 levels. And that's kind of confusing. So we did a simple example on the next slide. So here's an example. Okay, 2020 comes, your Q2 revenue declines 60% when compared to 2019. So that's an eligible quarter, and you're able to potentially take the credit on the wages in that quarter. So you go to quarter 3 and you recover a little bit. And so now your decline is only 42%. But because you haven't restored 80% of your 2019 gross receipts, then that quarter is an eligible quarter. Even though your decline is no longer 50%, the rules say it's still eligible because you haven't returned to 80% of 2019 levels. So now you get into Q4 and you finally get back to at least 80% of what you did in 2019. The rules say that quarter is also going to be an eligible quarter. And you basically have until the end of that quarter on which you could potentially claim this credit. So essentially, once you hit that 50% decline, you can potentially get a lot of quarters that qualify for the credit. And it's only after the quarter in which you get restored to 80% that it no longer applies. So it can be pretty beneficial. This, it's kind of a mixed bag, I would say. Excuse me. Some clients will meet this and others will have to qualify under the second rule that we'll talk about in a second, but this is the easier one to, one, prove, and two, it's more beneficial. You have a longer period of time on which you can claim credits. And you'll see that as we get into the second requirement, it's a little bit more narrow a little bit harder to qualify. So if you don't qualify by virtue of having a decline in gross receipts, the second way you can qualify is if during 2020, you had a period where business operations were fully or partially suspended due to orders from an appropriate governmental authority. And the, the guidance says that the order has to limit commerce, travel, or meetings due to COVID-19 in a manner that affects your operations and your business. And if you qualified under the first rule, all the wages for that quarter could be used. If you qualify under the second requirement, it doesn't make the whole quarter eligible. Rather, it only the wages that are paid during the period of suspension qualify. And so again, the scope is a little bit more narrow. And this can be hard to prove because the big point that the guidance describes is that it has to be a government order, and it can't be self-imposed. It can't be, it can't be just due to suggestions from government leaders. It has to be a legitimate order. And in order to take the credit, you've got to kind of go back and find out, okay, what order am I relying on? What was the date of the order? How long was it in effect? Because once that order is lifted and the business could have returned to full activity, you won't be able to claim the credit on the wages. So you have to really understand and you have to really understand what government orders are out there to know if you're eligible to claim the credit. So the IRS has a frequently asked questions page related to this credit, and they go through a bunch of different scenarios that says, well, how can we find out if my business qualifies as being partially suspended? And so it's a really helpful, if you're bored one night and you want to do some in-depth tax reading, it's really exciting. But we'll go through a couple of the questions. So for example, what if you voluntarily suspend operations or reduce your hours because of COVID? Does that qualify for partial suspension? It doesn't. And so you wouldn't be able to claim the credit in that case. What about if you have a business that has both essential and non-essential operations, and there's an order that makes that it says, okay, non-essential businesses have to close, essential businesses can stay open. In that case, yeah, you may qualify for a partial suspension. And the example they give there is a hospital. There was a time when the government ordered that elective procedures be suspended. But obviously a hospital is an essential business, so hospitals were able to remain open. And that was an example where, okay, we're essential, we're open, but we had a big part of our business that was closed, which was elective procedures. And so that's a scenario that you might qualify for a partial suspension. What if one of your suppliers was partially or fully shut down and you weren't able to get supplies from another supplier? And that's one where the IRS says, yeah, you may qualify for a partial suspension of business in that case. And again, it's important to note, like take the supplier example. If your supplier just was overrun with orders and things were just getting really crazy and they weren't able to fulfill their orders to you just because they were so busy, that doesn't count. It has to be, you have to trace it back to a government order. If there was a government order that shut your supplier down and that was the reason he couldn't get you the supplies, that's when you may be able to qualify. And again, the whole purpose of wanting to qualify as partially suspended is that if you qualify, then you can start taking this credit. So that's kind of why we're going through these examples, is we want to recognize, well, when can I potentially get this credit? What about there's a example in the FAQs about you're an essential business, but the government issues a stay-at-home order, and so people just aren't going out as much. But you're essential, so you're open. Could you get a partial suspension just because of that stay-at-home order? And they say no, you can't. And one of the scenarios that we thought of was, well, what about B2B sales? So you're a business that sells to other businesses. And what if your customer base is fully suspended and they can't operate? And as a result, they're not buying from you. Would you qualify for a partial suspension? And in my mind, I want to say yes. I just haven't seen the guidance anywhere on the IRS website or in articles that I read. So it's tricky. There's a lot of gray area. Not everything is spelled out, and everybody's circumstances are going to be so different that it's going to be hard to determine, well, was I partially suspended? I know there were government orders out there, and it just can get tricky. What about if you have to close your doors, but you're able to continue operations because you can have employees work from home? Then you wouldn't qualify. The number 34 talks about what if you have to close your workplace for certain purposes, but it can remain open for other purposes? And they would say, yes, you qualify. And I think the easy example there is a restaurant. In mid-March, all restaurants had to close their dine-in services, but they were still able to do takeout and drive-through. So they were open for limited purposes, but because they had a fair amount of their business closed, they would qualify for a partial suspension. If there's a reduction in operating hours, you can qualify. Or if you have multiple jurisdictions, let's say you've got, offices in multiple cities or states, and in one state you're forced to close your doors, but in the other states you can remain open. Then the IRS says that qualifies. They say a partial suspension in one jurisdiction causes you to be eligible nationwide. So that I think one of the tricky things is when it comes to like a partial suspension, let's say you have a portion of your business that is limited due to COVID and is due to a government order. Not only does it have to be limited, but the limitation has to have, the way the IRS describes it is that the limitation has to have more than a nominal effect on your business operations, which is not defined, of course. So it does make it a little bit tricky. You could say, well, hey, the government's mandated social distancing, which means I can't fill as much seats in my whatever business I'm running. And it would appear like, well, yeah, I think you qualify for a partial suspension in that case because you can't have the same capacity as you could in normal circumstances. But the question is does that limited capacity, is it affecting your business in a nominal way? Are you still getting the same amount of sales that you would? Or is there a pretty decent decline of business? So you kind of have to take all facts and circumstances into account. And again, you got to tie it back to a government order, which makes it challenging. So these are kind of, if you're thinking about your business and you say, well, we got a PPP loan, we never took this credit, but I think we might apply, or we might be eligible. This is kind of the steps I would go through. One, I'd say, okay, at any point in 2020, and this is starting on March 12th. So this is March 12th to the end of the year. Did I have a decline in gross receipts? That's the first thing you check, because that's, like I said, easier to prove, and the benefits are greater. It gives you a bigger window on which you can claim the credit on wages. If that applies, great. If it doesn't, you go to the full or partial suspension. And so if you determine that you meet one of those requirements, then you got to figure out, well, what period qualifies? And again, if you've qualified under the gross receipts decline, then you've got that whole quarter to work with, plus future quarters until you're restored to 80% of 2019 levels. If you qualify under the second rule, the full or partial suspension, you've got to identify what are the government orders, what was the period that I was affected by these government orders in more than a nominal way. And then once you've identified the period that qualifies, the next question to ask is, okay, well, am I a large employer? Do I have over 100 full-time employees? If yes, then you can only take into account the wages in the qualified period to employees that were not working. If you're 100 full-time employees or less, all wages qualify. So, and then the last step is, okay, I've determined I qualify, I determined the period, I've determined the wages that I can use. Then you've got to coordinate with your PPP loan forgiveness application to maximize both your loan forgiveness and your credit. And that can be challenging. You know, there's limitations on both sides, on both the loan forgiveness side, on the credit side, and it can get pretty jumbled. So, okay, so now we're going to talk about 2021. We just talked about the 2020 rules, how you can go back, evaluate your business, and see if you can get the credit retroactively. And so now we want to talk about, okay, let's say you've done that, and now you're moving on to the first quarter of 2021. This credit is still in play and it's still available. So we're going to talk about, well, what does it take to get the credit in the first 2 quarters of 2021? And to do this, we just we built a table to compare the rules in 2020 that we just went over, and now the rules that are going to be for the first 2 quarters of 2021. Because the new law, they extended the ability to take it only through the first 2 quarters. So similar to 2020 rules, there's the same type of requirements, but rather than having to show a 50% decline in gross receipts, in 2021, you only need to show a 20% decline. And the comparison period is 2021 to 2019. The credit is also, you're able to take more credit on a per employee basis. So if you recall, the rules for 2020 is you could take 50% credit on up to $10,000 of wages per employee per year. So $5,000 maximum for the year. Under the 2021 rules, you can get up to 70% of your employees' wages up to $10,000, but on a per quarter basis. So your maximum credit per quarter is $7,000, and your maximum credit for the 2021 year for those first 2 quarters is $14,000. So they've made the credit much more valuable, and they've also made it easier to qualify by decreasing the amount of required gross receipts decline. They've also made it easier to qualify by changing the definition of a large employer. And so remember, in 2021, if you had more than 100 full-time employees, the only wages that qualified were wages paid to employees who were not working. And they've changed the definition of a large employer to more than 500 employees. So that means that there will be more employers who are not large employers, which means they'll be able to take into account all wages. And the last major change is they've when trying to prove the 20% decline in gross receipts, I indicated you compared the 2021 quarter to the 2019 quarter, but they've also introduced an alternative method. If let's say you don't meet, let's say we're in 2021 first quarter and your gross receipts decline is only 15%. When in theory, you wouldn't qualify, but they have this alternative period that you can use. What you do is you go to the immediately preceding quarter, and then you compare that quarter to 2019. And again, kind of confusing. So an example always helps. So your standard method, again, you compare 2021 Q1 to 2019 Q1. If that doesn't work, you can try the alternative method. You go to the immediately preceding quarter, which is 2020 Q4, and you compare 2020 Q4 to 2019 Q4. So you can qualify in either way. You basically have two tests, 2 periods to use to see if you can make that 20% decline in gross receipts. So I've sufficiently confused everybody, I'm sure. This is not an easy credit to understand. And again, the interplay between calculating decline in gross receipts, figuring out government orders, whether they apply, figuring out, well, what wages can I include? What wages should I include? And how do I coordinate that with my PPP loan? It's very convoluted. And so, and again, it's going to be very facts and circumstances when it comes to the government orders and whether your business had a partial suspension of activity. And, you know, this is something this is not like a PPP loan. The SBA is managing the PPP loan program. This is an IRS credit. And so, you know, any credit taken is subject to IRS audit, and it could get risky if you don't feel like you have the right support, you know, proving a partial suspension of business. But the benefits are huge. I think being able to take advantage of this and a PPP loan together really is going to be a huge benefit if you can figure out that you're eligible. So we're going to move on now to a few other tax provisions in the law. I'm going to take a quick drink real quick. So as part of the CARES Act introduced in March, the SBA made payments on certain loans of small businesses. The new legislation just confirms that those payments are going to be excluded from income. So that's good news. There wasn't really a lot of guidance on that until now. President Trump, he kind of offered that payroll tax holiday from September to December of last year, allowing employers to defer the payment of employee Social Security tax. And originally, employers had to repay that from January to April of this year. The new law extends the repayment period to December 31st. So you've got the entire year to pay back any payroll tax that you might have deferred. This is obviously in the news. There's a second round of stimulus payments that are going out. Similar rules to the original ones. Amounts are a little bit less. And there's a lot of talk. In fact, today, President Biden is going to go over kind of his ideas for a new stimulus plan. And it's widely believed that there will be stimulus checks of $2,000. And it's also believed that it's not going to be a new $2,000 check. They're just going to true up this stimulus payment so that it gets up to $2,000. So if you got $600, you'll get an extra $1,400. So, and there's also a rule about business meals deduction, typically limited to 50%, but they're allowing businesses in 2021 and 2022 to deduct 100%. And that's in an effort to help the restaurant industry. The CARES Act there's an act called the Families First Coronavirus Response Act that was introduced in the spring of last year, and it established a requirement for companies that had fewer than 500 employees to pay certain sick and family leave that was related to COVID-19. So they were required to pay up to 80 hours. And if they did pay that, make the payment, then the government offered a tax credit to basically recompense the employer for paying those wages. So employers essentially were not out of pocket. And so the requirement to pay ended on December 31st. So companies no longer have to pay employees that are forced to take time off due to COVID-19. But if they choose to, then the payroll tax credits are still available through March 31st. So just something to keep in mind if you have employees that are forced to take time off due to quarantine, or because they have COVID, or because a family member has COVID and they're not able to work, you can pay them and you'll get refunded 100% of what you pay them. FSA benefits, there are some benefits there. Employers can roll their health and dependent care FSAs over from 2020 to 2021 and again to 2022, although it does require you to go in and amend your cafeteria plan. Okay, so those are, again, the bulk, I think, of the discussion of the new stimulus that was introduced in December is PPP loans and this retention tax credit. The other pieces there are relatively minor, but they are good to know. And the next thing we'll go over quickly is kind of what may come down the pipeline under President Biden. And the reason this is important now is because, or more important now than it normally would be, is because of the result of the last two Senate races in Georgia that the Democratic Party won. So now the Senate is now 50-50, with the tiebreak vote being Vice President Harris. And so in theory, the Democratic Party has control of both the House and Senate, which makes everything easier to get done for President Biden. I mentioned earlier that today he's introducing his plans for additional stimulus. When the most recent package that was $900 billion that we're talking about today, when that was passed, he called it a down payment. And he's, in his mind, he's looking at something in the trillions. And the slide shows some of the items that would be included. There's too many, it's too unknown right now to really figure it out, but I think some of the big ticket items is money for state and local governments, which was excluded in the last round of stimulus, the stimulus checks, expanded unemployment, and vaccine distributions and testing. That's a big one. So as we get more information about what he's looking at, we'll obviously disseminate that and have some resources for everybody. But it is likely that there will be more stimulus, and whether it's going to come in one big package or whether it's going to come piecemeal, it's hard to say. Even though the Democratic Party has both the Senate and the House, there are moderate, Democratic senators and that are wary of additional stimulus, and so it's not a home run in any sense. But at the same time, there's also members of the Republican Party that support additional stimulus. So it's going to be interesting how the negotiations go over the next month or so. So there are tax law changes that President Biden introduced during his campaign, tax policy, and by and large, his tax policy it seems to be to affect mainly high earners. So taxpayers with income over 400,000. He would like to introduce an increase to their top tax rate. And the big one that is going to be hard to swallow for some people if it ever gets passed is he wants to increase the tax on long-term capital gains and qualified dividends if you make over $1 million. And so it would essentially be a doubling the tax from 20% to a top rate of 39.6. He wants to allow taxpayers to claim more state tax deduction, but also he has plans to limit the amount of itemized deductions you can take if you're a wealthy individual. President Trump introduced the qualified business income deduction, which was a 20% deduction for pass-through income. President Biden has talked about wanting to phase that out for high income earners. And then in general, there's a lot of tax credits that he'd like to expand. And I think this is where, with additional stimulus, this is where you may see some of these tax policies creep in. In last year, the Democratic Party introduced what was called the HEROES Act, and which was a stimulus that never got passed. And part of that act had an expanded child tax credit, expanded dependent care credit, and so when it comes to the tax provisions of new stimulus, I would expect that it could be some of these credits that he wants to introduce. The estate tax, he's talked about reducing the estate exemption to 3.5 million. Currently, it's 11.7 million. Increase the tax rate and also eliminate the ability to step up the basis of assets upon death. Either that, or he wants to tax any unrealized gains at death. So if there are estate plans that need to be done and you want to take advantage of a higher exemption, now may be the time. And then he's talked about increasing the corporate tax rate, not back to Trump levels, but somewhere in the middle, 25 to 28%. He also has various corporate incentives to move work and manufacturing back to the U.S. and also wants to impose a minimum tax on C corporations that have book income over 100 million. And finally, this employment tax, he'd like to increase the Social Security tax limit to 400,000, which basically means if you make over $137,000, you'll be paying more Social Security tax than you're used to, which is not good for many. So as you can see, a lot of his policies, again, are geared toward taxing the high income earners more. So again, this is all speculative in the sense that nothing has been passed. It's just kind of good to know what could come down the pipeline. And most people seem to think that any kind of tax increase or major tax changes will not come early in his presidency, just due to a greater focus that he might have right now on vaccine distribution and additional stimulus. So most people seem to think that 2021 will continue as normal, but you never know what may happen. So good to know what's coming down the chain. Okay, so that's all we have. I haven't been monitoring the Q&A, but it looks like Rick has been answering most of these. There's one question here. Have you heard of anything related to extending the charitable contribution to 100% of AGI into 2021? And the answer is yes. The new law did extend that to 2021, if I recall. So that should be good. Okay. We'll give everybody a minute more if they want to throw any last minute questions on there. I would say, again, with the ability to take the employee retention tax credit in addition to your PPP loan retroactively to 2020 and now prospectively for the first 2 quarters of 2021, because it's so facts and circumstances dependent, your business, how it was affected, what government orders might apply. We encourage you to reach out to whoever your contact is here at Larson Company and just talk about the possibilities. I think that sometimes, you may write it off. I don't think we apply. I don't think it's going to, but I think it's worth having a discussion because, again, just due to the gray area and the potential to kind of maybe find a scenario where you may be able to apply. Thank you, Colt Smith. Kurt has a question. We are developing a medical device and had losses in both 19 and 20 with no sales. I assume we do not qualify for the PPP. I would tend to agree with you. Well, I guess the question, one question I have is if you received a first round of PPP and you're trying to qualify for a second round of PPP, I would tend to agree, just because you can't show the decline in gross receipts. And so it would seem that you'd be out of luck there. But if you didn't apply for a first PPP loan and you're looking to get in the door for the first time, you may be able to apply in the sense that if you apply because first time applicants, someone that never got a first PPP loan, their application is going to be based on the original rules, and the original rules, from the first round of PPP loans didn't have any gross receipts decline requirement. So someone in that position that you described that had no sales and losses for both years, if there were, wages paid and they were looking to get a first PPP loan, I think they could. It's just, yeah, if it was your second PPP loan, you wouldn't be able to, since you couldn't show declining gross receipts. Okay, and I think Margot can correct me if I'm wrong, but I believe, and I think this might have already been addressed in the Q&A, but we'll have the slides in the webinar will be posted to our website. And again, as questions come up, or if you want to explore the idea of the credit further, just reach out to your representative here. We've got good people ready and willing to help, and just want to make sure that people can take advantage of as much of the benefits that are being offered as possible. So thanks to everybody. I guess one last slide is here's the website for our articles, and this is where the webinar will be posted, where the slides will be posted. And it's got a bunch of different articles about all the legislation that's being passed. So thank you to everybody for coming on, and we will be in touch. And as more things happen, because there's going to be more stimulus, there's going to be more tax changes, we'll be here and ready to provide some insight and whatever guidance we can. So thanks, everybody. Have a great day.